Now, today we want to discuss the similarities between the Finance Bill 2024-2025 and this Finance Bill of 2025-2026. The state of our economy. How much is our inflation? What are the things affecting our economy? Both the macroeconomics issues and the microeconomics issues. We will highlight all of them. We will compare the status of our country to the neighboring countries, to the neighboring East African countries, Sub-Saharan countries, and the Central African countries, and the rest of the world. Now, this is going to be a longer conversation. Take your cup of tea, because you will find at the end of this session, you will go back with a lot of knowledge concerning issues to do with finance, to do with our economy, to do with the resources, and to do with money. I'm your host, Fadli Abdurrahman Mohammed. This is Sango Insight. Now, this paper, this document I'm holding, cameraman, Mr. Patrick, if you can zoom, this is an IcePack related document. It's been produced by that body. IcePack simply means Independent Certified Public Accountants of Kenya. Let's indulge in this particular report, which was released in 5th June this year, that is 2025. Presentation on microeconomics outlooks. About IcePack legal framework, it has 35,000 members both in public and private sectors of the economy. But this one is not our main agenda. Let's go to where our agenda is tonight. The first one is global macroeconomic development. The global economy has stabilized with projects of 3.2% in 2024 and 3.3% in 2025, up from 3.3% in 2022. This steady outlook is largely attributed to 1. The easing of global inflationary pressures, improvements in supply chain dynamics that were previously disrupted by COVID-19 pandemic and geopolitical tensions, stronger than anticipated economic performance in major economies such as USA, India, and the United Kingdom. In Sub-Saharan Africa, economic growth is projected to rise to 4.2% in 2025, up from 3.8% in 2024. This rebound is attributed to easing of supply constraints, reduced impact of previous climate shocks, gradual improvement in macroeconomic stability and investment. Now, this particular statement I've read something to do with macroeconomic development. Macro means the outer effects on our economy. Micro is inner. So macro are the things outside our country which are affecting our economy. Things to do with foreign exchange, things to do with unrest outside this country, like what is happening in Ukraine and Russia. The battle or the war between these two countries have affected our economy, not only our economy, but the world's economy, because most of the wheats, the sorghums, and things to do with plants are being imported from Russia and Ukraine. When the war started, those particular commodities were very hard to find because of war. and the prices went upwards, which was not being able to be controlled by the market demand and supply of our economy, which also caused some inflation. So that particular example I told you is an example of macro factor which affects our economy. So here they are telling us the global economy has stabilized with projected growth of 3.2%. The economy of the world has stabilized with 3.2% growth. What has caused that particular growth or that particular projected growth? Number one, they say the easing of global inflationary pressures. There was some ease, there was some relief on the issue of inflationary in the world. Also, number two, there was improvement of supply chains, which was previously disrupted by COVID-19. We remember COVID-19, the year 2020, 2021, and some part of 2022. There was no supply chain, there was no movement of goods and commodities in the globe because of that particular disaster or epidemic. Because most of the countries were closed. Most of the people were in quarantine because they were dealing with that particular disease of COVID-19. So there was no stable supply chain of goods and commodities from country to another. There was stronger economic performance in the major economies of this world, that is USA, India, Brazil, United Kingdom, and others you can mention. So let's come down to the sub-Saharan African countries, which Kenya is among it, our country. We have Ethiopia, we have Uganda, we have Eritrea, we have all other countries inside. The projected rise of economic growth in these sub-Saharan countries is 4.2% in this 2025. On the year 2024, it was 3.8%. What has caused this projected growth? We have three factors here. Number one, reduced impact of previous climate shocks. There was reduction in the impact of, the climate also affects our economy. Let's say there is this epidemic of rain, of floods, which has occurred to our country. I think it was year 2023, the end part of it. There was a lot of rains in our country. Yet, the economy was affected because all the places, there was no smooth and there was no transfer of goods and materials in the country. Majority of the places were closed. Kids were not going to schools. The education sector was postponed. A lot of things were postponed. There was no inter-county trade which was happening. At some time, Garissa County, which also is part of the counties it's among the 47 counties in our country, the bridge, which was easing the movement to and fro Garissa, was shut down because of the floods. And they were affected for at least 3 months. You can see how that particular damages that particular country and the economy at large. Because if they are importing some vegetables from other countries, it will be so hard it to come via road because the road is suspended, the road is destroyed. The only option is to transport it via air or flight or aeroplane, which will not come at the previous price. The price will go higher, and there will be a lot of inflation which will be caused. Also, gradual improvement in macroeconomic stability and investment. There is improvement on the macroeconomic factors I've mentioned: the political unrest in the world, the foreign exchanges, the wars, everything. Now, let's indulge on our economy. What is the projected growth of our economy? Our economy in this year is to remain resilient and stable. The projected growth is expected to be driven by a strong services sector, enhanced agricultural productivity, supported by favorable weather and distribution of subsidized fertilizer and seeds by the government. Kenya's real gross domestic product grew by 4.7% in 2024, a declaration from the revised 5.7% in 2023. While economic sectors posted positive growth, the overall moderation is attributed to weaker performance in agriculture, 4.6 and the significant contraction in mining and construction. So, what do we mean? Our GDP growth in the year 2023 was 5.7%, but it declined, it decelerated in the last year, that 2024, from 5.7% to 4.7%. What has caused that particular problem is there was weaker performance in agriculture, which has grown 4.6% compared to 6.6% growth in 2023. So the agriculture performance went from 6.6% to 4.6%. I bet there was a lot of factors that has caused that particular problem. Even if you remember, in 2024 there was a scandal whereby the farmers were being sold fake fertilizer. There was a lot of politics in that particular sector. I think that is one of the reasons why there was reduction in the growth of agriculture in that particular year. Also, the thing is, the mining sector has slowed down from 1.2% in 2023 to 6.5% in 2024. Also, the construction industry went from 3.0% in 2023 to 0.7% in 2024. There's a huge decline, it's a huge reduction. It's almost 70% reduction in construction center. And these factors caused our economy to start growing from 5.7% to 4.7%. Also, the funny thing is, in 2021, our domestic economic growth was 7.6%. This was when the previous president, Kenya, was having President His Excellency Uhuru Muigai Kenyatta. In 2021, our economic growth was projected to be 7.6%. That was so commendable. It went from 7.6% in 2021 to 4.7% in 2024. There is a huge reduction in the growth of the economy. Let's go forward. Let's talk about inflation. Using the language of a lay person, let's define what is inflation. Because a lot of people are hearing outside when the finance minister or the finance CS, that is Mr. Badi, speaks, communicates, and discusses about inflation, people tend to understand what is inflation. But today I want to illustrate inflation in a simpler terms. Inflation basically means is increase in the prices of commodities and services over time. What causes inflation? Inflation are caused by a lot of factors. One is domestic factor, and the other ones are external factors. The micro, that is domestic. The macro, that is an external factor. So, what are these some of the factors which causes inflation? The domestic factor is, or among the domestic factors are, when there is drought or excessive rains, the prices of food will increase, leading to an increase in inflation rate. That is one of the examples. When there is drought or when there is excess rains, which our country has experienced in the last 2 years, we have experienced a huge drought era and a very huge amount of floods, which has affected our economy, which has brought inflation. We have internal factors like increase or decrease of oil prices can also cause changes in inflation affecting movement in energy and transport cost. Also, what can cause inflation is depreciation in the exchange rate against the major currencies can also cause inflation, especially if a country a net importer of goods. Let me define this point. Also, inflation can be caused by depreciation of our currency to major currencies. What do I mean? You see, our currency now has been stabilized. I think currently it stands at 129.8. The last time I checked, I did not check today. But it came from 168 within a year. That is also very commendable if indeed it is not being controlled. The problem is if it is being controlled, then there is no particular dimension to be used to foresee the future and the future, how our currency can be tracked in the future. But if it is left to the demand and supply of our economy, and then the shilling appreciates against the dollar, against the sterling, against the pound, then that is a good thing. Also, if a country is a net importer, what do we mean by a net importer? A net importer is when the country imports more than it exports. So when you import a lot of things and you export less commodities, then there will be an imbalance in your currency. You'll be having a lot of dollars going compared to when you're exporting. When you're exporting, you're being paid by the currency of that particular nation you're trading with. But when you're importing, you're giving out the currency which you had. You see, that imbalance also causes inflation. Also, number three, inflation can be caused by factors that influence the demand for goods and services, like the amount of money ordinary people have available to spend. Inflation can be caused by the amount of money in the pockets of the ordinary citizen. What is he able to spend? How is he spending culture? He or she spending culture? Is he willing to spend that particular money in his pocket? Or is he willing to save that particular money? Or is he willing to hoard or to hide that particular money? The impacts, the negative impact of inflation is it makes it difficult for people to make long-term financial decisions as they cannot be sure about the future value of their investment and savings. Inflation causes one to not make a long-term financial decisions because he is not sure about his future savings and investments. Then that is a problem. That is where we draw the line between savings and investing. You see, when you save and you don't invest, automatically you will be hit by the inflation. But when you invest, let's say you have invested in land, however the inflation is, the land will appreciate in the coming years, maybe 3 years, maybe 5 years, maybe 10 years, who knows? But the amount of money you have saved in the bank will be hit by inflation. 100,000 back in 2010 is not the same as the 100,000 of 2025. It has depreciated. It has been hit so hardly by inflation. I remember in the year 2004, 2003, when we were celebrating the occasion of Eid, our family, the whole family used to spend 5,000. And that 5,000 will cater for our clothes, even buzi, and for all the things needed on that particular special occasion. But now, this shoe of mine is the cameraman is trying to zoom on the shoe, is almost 5,000. You can see that amount of inflation. You can see that amount of change. It is very serious. That's why, as a financial consultant, as a financial analyst, we normally advise people to invest rather than saving. Now, I'm not saying that saving is bad. Actually, saving is a good culture if you're saving to invest. Don't save to spend. Save to invest. Let me repeat it again. Don't save to spend. Save to invest. You can invest in land. You can invest in your children's education. You can invest in your own education. You can learn a degree. You can pursue a master. And you can also go for a PhD. That one is educational investment. You can go. You can start an industry. You can start a manufacturing. You can start and wholesale. All of those are investment. Whether buying shares in a company, whether buying stocks in Nairobi Security Exchange, all those are forms of investment. But saving to spend money, that is a big tragedy which is affecting our country today. That is why there is a lot of money in the pockets of the ordinary citizen. Our overall inflation in Kenya has declined steadily and remained below the midpoint of the central bank's target band of 5.0% since June 2024, signaling a return to price stability. Our inflation is doing good because it's below the 5.0%. That is a target set by the Central Bank of Kenya, which if you fall below that particular percentage, then you're good. We were at 4.7% and the target was 5%. So it declined from 7.9% in 2023 to 4.6%, which is good. Those reductions were attributed to reduction in prices of selected food and fuel items. Also, the food inflation dropped from 10.3% June 2023 to 5.6% in June 2024. This was mainly driven by price reduction in several non-vegetable items, which more than offset the increases observed in petrol prices. Also, fuel inflation has experienced 12.9% decline in 2023 to 6.4% in June 2024. And that particular factor was influenced by reduction in electricity tariffs and pump price supported by the lower international oil prices. Unsustained downward revision by the EPRA, that is Energy Petroleum Regulatory Authority. EPRA. Let's indulge into interest rates. From 2020 to mid-2022, Kenya's central bank rates remained stable at 7.0%. What has caused this low rate? This low rate environment was primarily in response to economic disruptions caused by COVID-19 pandemic. So from May 2022, the CPK began tightening cycle, raised the rates from 7% to 8.7% in November 2022. It was response to rising global inflation, especially due to supply chain disruption and Russia-Ukraine conflict, the matter I've spoken about in our not long time ago. And currency depreciation pressures as Kenya shilling weakened against the major currencies. That was 2022. Also in 2024, the CPK, that is the Central Bank of Kenya, aggressively raised the rates to 13%. What a huge rise. From 7.0% in May 2022 to 8.7% in November 2022 to 13% in 2024. Oh my God. Huge rise in a very short time. Why did it rise it to 13%, the interest rates? This is a result to response to persistent inflation, external pressures, the macro issues, that is the external ones, and the need to stabilize the economy. The need to stabilize the economy. In our coming episodes, we will discuss how raising the interest and lowering the interest, how does it affect our economy? And when do we raise the interest? When do we lower the interest rates? In 2025, that is this year, there is ease. The interest rate has been lowered to 10% in April. Why was it lowered? This was due to potential decline in inflationary pressures, stabilization of the exchange. Our exchange now has stabilized exchange rate. When you compare it to the dollar, it came from 168 to 129.8%. That is a huge. I have said before, if it is not controlled and it is left to the demand and supply of the commodities, then that is a huge step done by the government of the day. Let's move forward. We have seen the inflation rates, the interest rates. Now, we are at the exchange rates. The foreign exchange market remained stable in 2024 despite increased global uncertainties, effect of a stronger US dollar and geopolitical tensions in the Middle East. The Kenyan shilling exchange rate was weaker at the start of the year but strengthened against the US dollar in mid-February 2024 and has now stabilized against major international currencies. In December 2024, the exchange rate against US dollar was 129.4 compared to an average of cash 160.8 in January 2024, an appreciation of 19%. Against the euro, the Kenyan shilling strengthened by 22.2%. The exchange average of cash at 135.6 December 2024 to an average of cash 174.3 in January 2024. While against sterling pound, strengthened at 19.3% to exchange at an average 163.6% compared to an average cash of 202.9 over the same period. This recovery has restored confidence in financial market and significantly reduced the cost of servicing external debt, creating a vital fiscal space for development imperative. Let me indulge in this particular point. What they are saying here is, despite all the challenges in the world, that is the strong US dollar, the unrest in Middle East, as we speak now, there is a conflict between Iran and Israel. They are exchanging missiles. They are nuking each other. So those are one of the factors which are affecting, because now when they throw these bombs and these missiles at each other, the spaces, they close their spaces, they close the cargo and everything. Then the airplanes tend to take a longer trip than the normal ones, and the ships go to longer and waterline than the normal ones. Obviously, that's increased the prices of the commodities, which as a result also causes inflation, which as a result impacts the foreign exchange rate. So there was 19% appreciation of our cash. It came from 160.8 against the dollar to now, that is December 2024, 129.4 against the US dollar. It has grown by 19%. And I think up to now it plays at 129 points. The only thing that changes are the points that are changing. Also 22.2% compared to sterling and 19.3% compared to the pound. This stabilization, it has restored confidence in financial markets of our country and significantly reduced the cost of servicing the external debt. What does it mean? It means if your money is depreciated, when you are going to pay back the debts which are owed to our country, then you will use a lot of money to surface that particular debt. But when it is appreciated, then you will use a lot of less amount of money because your cash is somehow closer to the US dollar. Let's explain it to the lay person, to the layman. If today the exchange rate is 129, let's say it is 11,000. No, it is 13,000. If you gave me $1 and I give back to you 13,000. But if the cash depreciated and you gave me $1, you want me to pay you in cash, and the dollar appreciates, it goes back to 168, 160.8 something. Then I'm going to pay you something to do with 16,000, something to do with 17,000. You see, there's an extra 4,000, which is an expense because of appreciating and depreciating of the cash. So when I'm going to pay you the debts or the money which you owe me, then that extra amount of money will affect me because of appreciation and depreciation. So when our cash appreciates, then it is easy for us to pay our debts. Because of time, let us move forward. Private sector credit. There is growth in private sector credit from banking system. There is decline by 1.5% compared to 2023, which had a growth of 13.9%. What has driven that particular decline? Appreciation of Kenyan shilling, which negatively affected the value of foreign currency dominated loans. Lagged effects of monetary policy tightening by the central bank rate, the CBR, aiming at curbing inflation. Weakened credit flows in key subsectors like manufacturing, finance, insurance, and trade, while strong easing of monetary policy stance. Diaspora remittances. These are money we receive from diaspora, our relatives there who are sending money, or the people who are sending money back to this country. Those are diaspora remittances. The Kenyans who are living abroad, they did a great contribution to our country's GDP. The remittances sent to our country is estimated to cover 4% of our GDP. And that is a huge improvement because when there is a lot of remittances, a lot of money from external, then it increases the amount of dollar we have, which makes our cash to appreciate against the dollar. And which also increases the amount of dollar we have in our reserves. The President, His Excellency, President Ruto, was speaking the other day, and he was kind of praising himself, saying that his government has the largest reserves of dollars. It was estimated to be, I don't remember the correct figure, but I think 10.8 billion US dollar reserve So, it is expected that the remittances sent will increase up to 1 trillion come the year 2027. The funny thing is, our country is now earning foreign exchange from diaspora remittances than from its major exports, that is coffee, tea, and horticulture. Whatever we export and whatever money we get from outside, the remittances we get from outside, which basically are not part of trade proceeds, the remittances are covering up the exports. Meaning the remittances are bringing a lot of dollars than the exports we are exporting. Kenya is known for exporting tea, coffee, horticulture, and others. In 2024, the remittances have reached a record of 4.9 billion, equivalent to cash 640.75 billion, marking an 18% growth from the previous year. The United States of America has remained to be the largest source, contributing 51% of the total inflows. The remittances sent to our country, 51% comes from USA, and other 49% comes from other nations or other countries in the world. International trade and balance of trade. In 2024, Kenya merchandise trade grew by 5.5%, reaching 3,818.6, up from 3,621.9 in 2023. Our exports increased by 10.4% from 1 trillion 700 million from 1 trillion 7 million to 1 trillion 102 billion in 2024. Also, our import grew or rose by 3.6% from 2.6 trillion to 2.7 trillion. The growth in its exports outpaced the input, resulting to marginal improvement in the trade deficit, which reduced from 1.6 billion to 1.5 billion. The export-input cover ratio improved from 38.6% in 2023 to 41.1% in 2024, indicating a modest progress towards improving the trade balance. Also, that is commendable because the export to import cover ratio has increased from 38.6% to 41.1%, meaning our export is rising a bit. What is the advantage of that? What are the pros of that? The pros of that is when we want to have a balance when we want to stabilize our economy, we need the import and export need to balance against each other. But if our imports are more than our exports, then we're not doing good as an economy, because we're importing a lot of things. We're not supporting the local industry. We're not supporting the local manufacturing or the assembly, the local assembling of vehicles. Everything local is not being supported if there are a lot of imports rather than exports. But if there's a lot of exports, it means then we are heading somewhere good as a country. But as per 2024, the gap has reduced. The gap between the imports and export has reduced. It went up to 41.1% from 38.6%. What has caused that particular? Improved in export performance, increased services income, higher diaspora remittances, and increased interest received upward. Let's come to the important thing, that is public debt. Our public debt stands at 11,364 billion at the end of the quarter March 2024, representing 65.7% of our GDP. Again, it is huge. 65.7% of our GDP. The rent is equivalent, the debt is equivalent to 65.7% of our GDP. On this amount, that is the 11,364 billion, 6 trillion is domestic debts, and 5.2 trillion is external debt. In June 2024, the external debt declined by 5.4% to cash 5,150.8, representing 31% of the GDP and 48% of the total public debt. The reduction was largely attributed to the exchange rate performance. Let's discuss the external debt composition. Kenya external public debt stock was composed as follows. Multilateral debts. It amounted to 2.7 trillion, accounting for the largest share at 53.9%. Commercial debts stood at cash 1.2 trillion, representing 23.4%. Bilateral debts were at 1.15 billion, comprising 32.4%. Export credit remained at the lowest with 14 billion. This is 0.3%. That is our external debt. We have our external debts are composed of multilateral debts, commercial debt, bilateral debt, and export credit. Let's discuss the challenges to debt management in Kenya. Credit rating downgrade leading to higher borrowing costs, reduced investor confidence, and limited access to credit markets. Our credit score is very low because we borrow too much. Sometimes we default, which reduces the confidence of the investors and limited access to credit markets. There is weak legal and institutional framework. The PDMO, the Public Debt Management Office, lacks autonomy. Overlapping mandates between the CPK and the National Treasury create inefficiency. Cash flow constraint. Tight budget force reliance on borrowing to fund government operations. Fiscal deficit and rising debts. There is a gap when our budget is being read. There is a gap, like now, our fiscal deficit for this year was adding up to 900 billion, which we will cover it using borrowed money. Exchange rate risk, regulatory and market volatility, slow legal reforms, limited public debt literacy, and short-term debt burden. Those are challenges to our debt management in our country, Kenya. Factors contributing to high debt accumulation. Kenya has witnessed a persistent fiscal deficit averaging 8.1%. Of the gap between the budget and the money we had was averaging at 8.1% for the last 10 financial years. That is a bit serious. And it came down at 6.1% financial year 2022-2023. Debt servicing cost. Debt servicing cost has been on the rise, with debt service revenue ratios averaging at 41.2% over the last 10 financial years and standing at 64.3% as September 2020. Shortfalls of revenue collections. Normally, KRA does not reach its targets. They had a target of 2 point something trillion. They went below that. Despite the significant growth in tax revenues, the Kenya KRA has most following short only tax revenue targets. It does not reach its targets. And also the guaranteed loans by government of Kenya. We will continue in the next episode. But the thing is, all East African countries, our country even overlaps the budget of Uganda. Our budget for this year, 2024-2025 finance bill, 2025-2026 finance bill was 4.2 trillion. While the other countries, a country like Uganda, 2.7 billion, a country like Tanzania, 2 point something trillion, a country like Ethiopia, which has a population of 120 million, its budget was 2.2 something trillion. Rwanda even has not reached a trillion, it was 600 billion something. We are the biggest economy in this East African country. Why are we not so developed? Why is our budget so huge, yet comparing to the development agenda, we are so back? That is the questions we need to ask ourselves, and that is the topic we will discuss in the next coming episode. Thank you so much for staying with us. Keep in touch. This is Sango Insights.